Everyone thinks a catchy jingle and a cute sock puppet guarantee success. They're catastrophically wrong. The year 2000, a new millennium, a new economy, and the promise of untold riches for anyone with a calm after their name. Pets. Calm was one such hopeful, a digital pet store that burned through hundreds of millions, only to vanish within 268 days of its IPO. This wasn't just another casualty of the dot-com bust. It was a poster child for the irrational exuberance, the flawed business models, and the sheer audacity that defined an era. A company selling 40-pound bags of dog food online with free shipping was perhaps doomed from the start. The story begins in 1998, as the internet gold rush was hitting its stride. Pet supplies seemed a perfect fit for e-commerce. Pet owners are loyal, their purchases are recurring, and the market was enormous, or so the thinking went. Pets.com launched with ambitious plans, backed by venture capital firms like Hummer Winblad and, crucially, Amazon. Yes, Amazon. Their early involvement lent an air of legitimacy, a stamp of approval in a wild, unregulated landscape. The company's strategy was simple, if deeply flawed: acquire customers at any cost. This meant lavish advertising campaigns, most famously featuring the now iconic Pets.com sock puppet, singing about saving money. The sock puppet became a phenomenon, a marketing triumph. It appeared in Super Bowl ads, on national television, and became a symbol of the dot-com era's quirky optimism. People knew Pets.com, but knowing wasn't buying, not profitably anyway. The operational nightmare was staggering. Shipping heavy bags of pet food, litter, and bulky accessories across the country for free or for a nominal fee simply eradicated any profit margins. Their unit economics were, to put it mildly, catastrophic. They were paying more to deliver a product than they were selling it for. It was a race to the bottom, funded by investor cash, with the hope that scale would somehow magically make the numbers work. Scale, however, only amplified the losses. By 1999, Pets.com was bleeding cash, yet the IPO market was still red-hot. The promise of the internet, regardless of current profitability, was enough to entice investors. They went public in February 2000, raising $82.5 million. The stock soared initially, reaching a peak of $14 per share, valuing the company at nearly $300 million. For a brief moment, it seemed the gamble had paid off. The market was validating their costly growth strategy. But beneath the surface, the rot was setting in. The burn rate was unsustainable. They were spending $2 million per month on advertising and over $10 million on shipping and product costs. The IPO money was a mere bandage on a gaping wound. The dot-com bubble, inflated by speculative investments and unrealistic valuations, was about to burst. The Nasdaq began its steep decline in March 2000, and Pets.com's stock followed suit, plummeting relentlessly. By September 2000, their stock was trading for less than $1. The company, which had once been heralded as an e-commerce pioneer, was now a pariah. The dream of dominating the online pet market was rapidly turning into a nightmare. In November 2000, Pets.com announced its liquidation. Less than a year after its IPO, the company shut down, laying off 250 employees. The remaining assets were sold off, including the famed sock puppet, which fetched a mere $125,000. The Pets.com story is a brutal lesson in business fundamentals. Hype, marketing, and investor enthusiasm can only carry a flawed business model so far. Eventually, gravity asserts itself, and economics always win. The company's failure wasn't due to a lack of vision or effort. It was a fundamental miscalculation of logistics, customer acquisition costs, and the true cost of doing business in a nascent online retail space. Ironically, the online pet supply market eventually became incredibly successful, dominated by companies like Chewy, but they learned from the Pets.com mistakes, focusing on efficient supply chains and sustainable growth. Pets.com remains a cautionary tale, a symbol of the dot-com bubble's excesses, a reminder that sometimes the simplest ideas are the hardest to execute profitably. especially when blinded by the promise of exponential growth. The puppy that never barked became a phantom limb of the internet's early years, a ghost of ambition that haunts every startup pitch deck. Next, we unravel the intricate web of lies that brought down Enron's energy empire.